Welcome to today's deep dive. If you think about stepping into any kind of established financial market today, there's, a baseline expectation of standard infrastructure.
Right, absolutely.
It's kind of like buying a house. You don't just walk up to the seller carrying a literal briefcase full of $100 bills.
No, I mean, that would be ridiculous. You get a mortgage.
Exactly. You put down a fraction of the total cost, you apply leverage, and, you amplify your purchasing power. But if you step into the exploding world of prediction markets right now, suddenly you're back to lugging around that heavy briefcase of cash.
Yeah, which is honestly a massive structural gap in the current ecosystem. Platforms like Polymarket have, successfully turned questions about world events, election sports into highly liquid contracts.
Right. Millions of dollars moving on single questions.
Literally millions.
Mhm.
And the price of a binary contract effectively acts as this real-time read on the probability of an event happening.
Hmm.
Yet, for all that volume, the most basic tool of capital efficiency, leverage has been entirely absent.
Well, let's look at the mission for today's deep dive because we're unpacking a protocol called Predmart, which is stepping in to build that exact missing mortgage infrastructure, so to speak, for the prediction space.
It's a really necessary fix. But before we get into how Predmart solves this, we should probably clarify a crucial distinction from our sources.
Oh, right, because if you follow this space closely, you might be sitting there thinking, wait, didn't Polymarket just launch a leverage product?
They did, yeah.
Yeah.
And it's a vital distinction. They introduced leveraged perpetuals, allowing up to, I think, 10 times exposure. But those perpetuals are built strictly on traditional crypto assets.
Like Bitcoin or Ethereum.
Right. Bitcoin, Ethereum, regulated commodities. That product operates under a very specific derivatives framework.
So the actual binary event markets that made them famous, like the will this specific thing happen by this exact date contracts, those still have zero native leverage.
None. Zero. If you want to trade a geopolitical outcome or, I don't know, a pop culture event, you are trading one-to-one.
Got it. And that's why Predmart exists, right? They aren't trying to compete with the crypto perpetuals.
Exactly. They are building the one specific capability that the binary event markets lack.
Okay, let's unpack the actual shape of the problem here. Because when a trader is forced to trade one-to-one, an event outcome usually trades as a share price between, what, $0 and $1?
Yeah, $0 and $1. If the event happens, it resolves at $1. If it doesn't, it resolves at 0.
And that binary nature is where the capital inefficiency gets pretty glaring, right?
It's extremely glaring. Imagine you're analyzing a market and a contract is sitting at, say, 60 cents. But your research strongly indicates the true probability is closer to 70 cents.
So you buy the contract at 60.
Right. And if the market eventually agrees with you and moves to 70 cents, you capture a 10-cent spread. Or, you hold it to resolution and capture 40 cents if it actually hits $1.
Which, honestly, is a very clean way to express a view. But from a capital velocity standpoint, it's incredibly sluggish.
Sluggish is a good word for it. Going back to your house analogy, you were buying the house in pure cash.
Right, just handing over the briefcase.
Yeah, and capturing that 10-cent edge means you're tying up a massive percentage of your available liquidity for what is, in absolute terms, a pretty modest return.
Especially since the most compelling mispricings often sit in markets that won't resolve for weeks or even months.
Exactly. You hit a ceiling so fast.
Yeah.
If you have deep conviction about an outcome, there was simply no way to size up your position without just, dumping more of your own cash into it.
Yeah.
Your conviction was strictly capped by your liquid cash.
Which brings us to Predmart. It's a non-custodial margin account built on the Polygon network. And from the sources, the user experience seems designed so you don't have to deal with the messy parts.
Yeah, you don't have to manually juggle borrowing or execute multiple smart contract transactions.
Right. You just enter an amount, grab a slider, adjust it to up to 5 times leverage, and click a button.
The machinery is completely abstracted away. Under the hood, there's this complex lending protocol. Lenders supply stablecoins to earn yield, and outcome shareholders deposit their shares as collateral. But the directional trader just sees the slider.
Let's walk through the math of that slider, actually, because the mechanics of how this amplifies a position dictate basically everything else about the protocol's design.
It does. Let's say you put up $100 of your own capital, and you slide the leverage up to 5 times.
Okay, so I now have $500 of purchasing power. My original 100 plus 400 lent by the protocol.
Right. You take that $500 and buy into an outcome trading at exactly 50 cents. With $500, you acquire 1,000 shares.
Got it. 1,000 shares at 50 cents.
Now let's assume your thesis plays out. The market reprices that outcome from 50 cents to 60 cents.
Okay, so my 1,000 shares are now worth $600. And let's say I decide to exit the position. I sell the shares for 600. The protocol automatically takes back the 400 it lent me.
And you're left with $200.
Wow. Wait, so I started with $100 and I'm walking away with 200.
Exactly. A 20% move in the underlying market from 50 cents to 60 cents just resulted in a 100% gain on your actual capital.
Okay, let's unpack this. Because, I mean, leverage acts like a magnifying glass, right? It scales up a 20% win into a 100% return, but the physics of leverage dictate that the math must be identical on the downside.
Oh, absolutely. It cuts both ways.
Right, so if I buy at 50 cents and the market drops, how tight is the margin for error before the protocol forces me out?
It is razor thin, and the sources emphasize that Predmart makes no attempt to cushion that reality.
So no safety net.
None. If you buy at 50 cents with 5 times leverage and the price drops toward 40 cents, the value of your shares is dropping fast. The moment the total value of your position threatens to dip below the $400 you borrowed, your original $100 stake is wiped out.
It's just totally gone because the protocol will always prioritize the lender's capital over the borrower's position.
Exactly. The protocol automatically closes your position to recover the lender's $400. Your stake absorbs the entirety of the loss.
So leverage heavily rewards discipline, but it ruthlessly punishes a poorly timed entry.
Very ruthless.
Which brings us to a massive systemic question. My individual $100 getting wiped out is one thing, but prediction markets are notoriously volatile.
Very true.
Like news breaks, and a contract can flash crash 30% in a matter of seconds. If 1,000 traders get caught offside at the exact same moment, how does the protocol survive that cascading panic without going bankrupt itself?
That's the real challenge. Lending against prediction markets is orders of magnitude more complex than lending against traditional assets. To survive that volatility, Predmart had to engineer 5 specific structural safeguards.
What's the first one?
The first is how they value your position. At any given millisecond, they do not look at the last traded price. They mark positions strictly against the best bid on the live order book.
Wait, really? Marking to the best bid makes sense for, establishing true liquidity, proving what you could actually sell for. But doesn't that severely penalize the trader if the spread is unnaturally wide?
It can, yeah.
Like if the last trade was at 50 cents, but the best bid just happens to be sitting way down at 40 cents because the market is quiet, am I getting liquidated based on an illusion?
It is a harsh valuation, but it's structurally necessary. Think about it. If the protocol used the last traded price, the system could easily be manipulated.
Oh, so?
Well, a bad actor could just wash trade a single share at an artificially high price. That would inflate the apparent value of their collateral, and they could borrow more against it.
Oh, wow. I see.
Yeah, so by anchoring the valuation to the best bid, the actual money waiting on the other side of the trade, the protocol ensures the collateral is genuinely liquid.
Okay, so it forces traders to care about the depth of the market they are entering, not just the theoretical price. But what happens when that order book is incredibly thin?
That's the next big risk.
Right, because if a market has very little volume, a whale could just dump a moderate amount of shares, obliterate the best bid, and artificially trigger a wave of liquidations for everyone else.
And that specific vulnerability is why they built the second safeguard, the depth gate. It acts as an automated circuit breaker.
How does that work in practice?
The protocol constantly monitors the state of the order book. If it detects that the available liquidity is dropping too rapidly within a short time window, which usually indicates either extreme panic or intentional manipulation, the depth gate slams shut.
Meaning it just halts all new borrowing for that specific market.
Exactly. It prevents bad actors from exploiting a momentarily shallow market to extract excess leverage.
That makes sense. It stabilizes the bleeding before the lender's capital can be threatened.
Right. But that addresses market manipulation. You also have to consider the fundamental nature of the contracts themselves.
Yeah, because a 5-cent drop on a contract priced at 90 cents is basically just statistical noise. But a 5-cent drop on a contract priced at 10 cents, I mean, that's a 50% wipeout.
Exactly. The borrowing rules can't possibly be identical across the entire price spectrum.
Right.
And they aren't. What's fascinating here is their third safeguard, how they manage the loan-to-value ratio, or LTV. In traditional finance, an LTV might be a static percentage. In Predmart, the LTV is highly dynamic.
So it scales up and down based on the current price of the share.
Precisely. If an outcome is trading at 90 cents, the market consensus is that the event is highly likely to occur. So the allowed leverage is higher.
Because the risk of it suddenly going to zero is lower.
Right. But as that contract drifts downward, heading towards zero, the risk profile changes geometrically. The protocol sharply tightens the permitted borrowing power.
It's basically the equivalent of a credit card company dynamically lowering your limit the moment you lose your job. It's aggressive risk management.
That's a great way to put it. As a contract approaches zero, the leverage available effectively evaporates because the probability of the collateral becoming completely worthless is imminent.
Okay, so we have dynamic LTVs, best bid valuations, and depth gates. But who is actually pulling the trigger when a position breaches that risk threshold?
That would be the fourth safeguard. The liquidation engine. It's a continuous automated process monitoring every single open position against the live order book.
So no grace periods.
None. It doesn't wait. It
Right.
doesn't issue a margin call asking you to politely deposit more funds. The instant your position crosses the threshold where the lender's capital is exposed, the engine executes a close.
Fast, ruthless, and entirely devoid of human hesitation. And all of these liquidations and loans have to be backed by actual capital. If multiple massive markets, say an election night with dozens of interlocking state-level contracts, if they all experience wild volatility at the same time, how is the underlying liquidity structured to absorb that shock?
This is the fifth and final structural piece, and it's a critical architectural choice highlighted in the sources. Predmart utilizes a unified liquidity pool.
Okay, what does that mean exactly?
Well, rather than creating isolated, fragmented lending pools for every single individual market, like one pool for a geopolitical event, a completely separate pool for a basketball game,
Yeah.
they group all the lenders' stablecoins into one massive central pool.
Oh, I see. So instead of a dozen small shock absorbers that could easily bottom out, they have one massive shock absorber.
Right, because if you fragment liquidity, you end up with harsh borrowing caps on niche markets
Yeah.
or insane interest rate spikes when demand surges for a specific event.
But a unified pool mutualizes that liquidity across the entire platform.
Exactly. It creates a much deeper, more resilient market. Leverage becomes reliably available regardless of whether you're trading a highly publicized global event or a much quieter niche contract.
So we have a system engineered with best bid valuations, dynamic risk scaling, circuit breakers, liquidation engines, and unified liquidity.
It's a lot of infrastructure.
It is. But, theory is one thing. In the realm of decentralized finance, we're talking about traders putting up real hard-earned collateral in an environment designed to instantly liquidate them if they're wrong.
Yes, the stakes are very real.
So the smart contract security has to be absolutely ironclad. We know it's non-custodial, and it's tracked on directories like Defalama, but the sources also lean heavily into their audit from Hashlock.
Which is huge, because in a non-custodial setup where the protocol logic lives entirely on-chain on the Polygon network, code is literally law.
Right, there is no customer service desk to call to reverse a bad transaction.
Exactly. And Hashlock's involvement is significant here because securing lending protocols requires a very specific type of rigorous stress testing. They've secured billions on-chain for massive clients.
Right, an audit isn't just checking for basic typos in the code. It's simulating those exact flash crash scenarios we just talked about to ensure the liquidation engine doesn't freeze when the network gets congested.
Exactly. It's the baseline requirement for trust when you're asking users to risk their collateral. It removes the counterparty risk of dealing with a centralized exchange and replaces it with verifiable, audited, smart contract logic.
But even with top-tier verification and deep liquidity, the risk profile of this tool is intense.
It is not for the faint of heart.
Which raises the ultimate question. Who is actually willing to take on this specific level of risk? Because clearly, this protocol is not built for the casual participant.
Definitely not. The sources actually outline 3 distinct profiles of traders who actively need this kind of infrastructure.
Okay, let's go through them. Who's the first?
The first is the conviction trader. This is someone who specializes in deep, granular research. They might uncover a statistical edge, indicating a market is mispriced by, say, 10%.
But without leverage, a 10% edge is barely worth the time it takes to research it, right? Let alone the opportunity cost of locking up the capital for weeks.
Exactly. Leverage allows the conviction trader to turn a small, hard-won probability edge into a meaningful absolute return. It rewards the effort of deep research, by allowing them to scale their exposure proportionally to their confidence.
Makes sense. Okay, the second profile mentioned is the capital efficient trader. I imagine this is someone managing a wider portfolio of positions.
Yeah, this trader wants exposure to multiple, uncorrelated theses simultaneously. Like, they might have a view on an election, a view on a central bank rate decision, and maybe a view on a tech company's product launch.
And in a one-to-one market, they have to splinter their capital across all three, which just dilutes their potential return.
Right. Predmart allows them to maintain that broad exposure without tying up their entire liquid net worth. They could just do more with less.
And the third profile is perhaps the most interesting regarding market dynamics, the event-driven trader.
Yes, the event-driven trader operates on a completely different timeline. They are not holding a position for 3 months waiting for an election.
Right, they don't care about the long game.
No, they are positioning themselves ahead of a highly specific, immediate catalyst. Think of a Supreme Court ruling dropping at 10:00 a.m. or an inflation report releasing at 8:30 a.m.
Oh, wow. So they use leverage to aggressively size up their position minutes before the catalyst. The news breaks, the contract instantly reprices from, say, 40 cents to 80 cents, and they just exit the position immediately.
Precisely. They are in and out, utilizing the leverage to maximize the impact of a violent, short-term price discovery phase.
Here's where it gets really interesting, though, because as much as the sources outline who this tool is for, they are equally adamant about who it is not for.
Oh, absolutely. Predmart is explicitly not for passive holders.
Yeah.
It is not a tool you use to express a casual opinion and then walk away from your screen for a week.
Because it is entirely unforgiving. If you can't financially or emotionally respect a hard liquidation point, this infrastructure will just consume your capital.
It really will.
It treats the user as an adult, it provides the financial physics, but it takes absolutely zero responsibility for how you choose to navigate them.
Right. And if we connect this to the bigger picture, the arrival of this kind of infrastructure is a massive signal about the trajectory of prediction markets as a whole.
How so?
Well, for a long time, event contracts were viewed as a fringe experiment or, just a novelty. But they are rapidly maturing into highly legitimate venues for forecasting.
Yeah, when real capital is on the line, the noise gets filtered out. We're seeing these markets frequently front-run traditional polling and expert analysis.
Exactly, because the financial incentive to be right overrides inherent biases. And as that legitimacy solidifies, the financial plumbing supporting these markets has to evolve.
Because in every other developed financial market, globally, equities, commodities, forex leverage is just a foundational utility.
Exactly. The fact that event contracts lacked it was really a historical anomaly. Predmart isn't just a new protocol. It represents the normalization of prediction markets.
So what does this all mean for you? It fundamentally changes the calculus of how these markets are traded. It takes a static, one-dimensional bet and transforms it into a dynamic position where your capital velocity can finally match your analytical edge.
Which is huge.
Yeah.
The underlying mechanics of the market have fundamentally changed. The tools are now aligned with the maturity of the asset class.
Right. In a rapidly expanding ecosystem, the ability to efficiently size your conviction is transitioning from a luxury into an absolute necessity.
Absolutely.
But I want to leave you with a final thought to mull over, one that stretches beyond just the mechanics of the protocol. We know that leverage heavily amplifies the financial reward for being right about world events.
Yeah.
So, does the presence of that leveraged money actually force prediction markets to become vastly more accurate because the financial incentive to conduct deeper, better research is now exponentially higher?
That's the bullish view, yeah.
Or does the constant looming threat of instant liquidation cascades, traders being forced out by margin calls rather than actual changes in underlying probability, just make our real-time view of the future that much more chaotic and unreliable?
It's a great question. It really raises an important point about market psychology. The financial tool itself is entirely neutral, but the human behavior driving the order book never is.
It brings us right back to where we started. The era of showing up to the market with a briefcase full of cash is over. The deep financial infrastructure has officially arrived. How we adapt to that new reality is entirely up to us.
Well said.
Thanks for joining us on this deep dive. We will catch you next time.